Welcome to this explainer. Today, we're putting on our detective hats to conduct a rigorous, professional-grade stock valuation of Belden Inc. using its latest financial metrics. I'll be stepping into the role of your lead equity analyst, and our goal here is pretty simple, really. We want to determine the true intrinsic value of this business by stripping away all that market noise and focusing purely on the hard data derived from our source materials. So, let's dive right into it. Right now, Mr. Market has slapped a very specific price tag on Belden stock, exactly $114.15 per share. When you multiply that by the number of outstanding shares, you're looking at a company with a $4.44 billion market cap. Basically, that's exactly what you have to pay today if you want a piece of this industrial technology pie. But as financial detectives, the real mystery we need to solve today is whether this price tag actually reflects reality or if investors are just, overpaying for the underlying business. You know the old saying, price is what you pay, but value is what you get. Our job is to figure out if that $114 is a massive bargain, a fair deal, or a really risky premium. To crack this case, here's our roadmap. First up, the Belden valuation mystery. Then we'll look at absolute value, where cash is king. Third, relative value, basically the peer check. Fourth, asset value, which is our floor price. And finally, we'll wrap it up with the final intrinsic verdict.
All right, starting with part one, the Belden valuation mystery.
Before we try to project the future, we really need to look under the hood. Check out the sheer scale of the operation here. We've got a solid baseline with over $2.7 billion in trailing 12-month revenue, which drops down to nearly $238 million in net income. But more importantly for our valuation models, Belden generated nearly $219 million in free cash flow. Coupled with an 11.43% return on invested capital, this gives us the high-quality raw fuel we need to start building out our models. Moving on to part two, absolute value, where cash is king. So our first forensic tool looks purely at the company's own financial engine. We're completely ignoring market sentiment or what other companies are trading for right now. The absolute most powerful tool here? The discounted cash flow, or DCF model. Simply put, this model calculates the present value of literally all the cash Belden will ever generate from today until the end of time. Because at the end of the day, a business is ultimately only worth the cash it can actually put into its owner's pockets. To build out this DCF, we're going to follow a pretty strict mathematical procedure. Step one, we project the free cash flows over the next 5 to 10 years, using that $218.69 million we just talked about as our launch pad. Step two, we apply a discount rate, usually the weighted average cost of capital, to translate all those future dollars back into today's value, which accounts for risk and time. And step three, we add the terminal value that represents what the company's worth in its steady, mature stage. Now, here's the crucial thing to remember. Any DCF is incredibly sensitive to its inputs. Because our specific source documents don't just hand us a magic crystal ball from management's exact future discount rate targets, we've got to act as prudent analysts and rely on sensible defaults. We're assuming a standard 2 to 3% terminal growth rate, which is roughly in line with global GDP, and a 5 to 6% market risk premium, just to really ground our math in reality. Okay, so when we actually run the numbers using Belden's free cash flow against these structural realities, the source material explicitly calculates a fair value price of exactly $84.24 per share. Let that sink in. That's our first major clue right there. Based purely on the cash it generates, the intrinsic value is sitting in the mid-80s. That is way below that $114 market price we saw earlier. We can also look at a couple of other absolute models to be thorough. Now, the dividend discount model is pretty weak here. Why? Because Belden's dividend yield is a tiny 0.18%, with a payout ratio of just 3.32%, meaning they hold on to almost all of their cash. However, a residual income model is much more intriguing. We take their really impressive 18.78% return on equity and compare it against a price-to-book ratio of 3.52. This basically tells us that management is highly effective at generating returns on shareholder equity, even if the current market premium on that book value is honestly quite high. All right, on to part three, relative value, the peer check. Here is where we step out of our vacuum and see how Belden's pricing actually compares to its industry neighborhood. This helps us figure out if the market is treating Belden fairly compared to similar businesses. Our source gives us Belden's specific multiples, a trailing PE of 19.31, a forward PE of 15.70, and an EV to EBITDA of 12.01. Now, because specific peer data is missing from the file, we have to list reasonable publicly traded peers for industrial tech, companies like Amphenol or TE Connectivity. Against those typical industry standards, Belden's multiples actually look fairly modest. An EV to EBITDA of 12 is often considered a totally reasonable, maybe even attractive multiple in this specific sector. And this brilliantly illustrates the real tension in stock valuation. Relying on just one single model is a total trap. Absolute valuation shows us the cold, hard cash reality, which for Belden points to a lower fair value. Relative valuation, on the other hand, shows us the current mood of the market, suggesting that compared to its more expensive peers, Belden might actually look like a decent relative deal. Let's move to part 4, asset value, looking for the floor price. This approach is the equivalent of stripping the company right down to the studs. We're ignoring future growth entirely to find the absolute floor price. We're looking for the net asset value. This effectively answers a grim but super essential question. What exactly would be left for shareholders if Belden closed its doors today, paid off all its debts, and sold literally everything else for scrap? So even without a line-by-line balance sheet to manually adjust to fair market values, we can still deduce the health of this floor price from our source metrics. Belden has healthy short-term liquidity with a 1.93 current ratio and a 1.36 quick ratio. That means it can easily cover its near-term obligations. But it does carry a moderate debt load with a 1.02 debt-to-equity ratio. And because the enterprise value to assets is 1.51, this tells us the market is pricing the company at a strict 50% premium to its raw asset base. So the net floor is solid, but it's well below the current stock price. Finally, part 5, the final intrinsic verdict. We've processed the clues through our absolute, relative, and asset-based models, and now it's time for the grand synthesis. Laying all these numbers on the table, we're seeing a really stark discrepancy. Our absolute models, which, by the way, are generally the most reliable for mature cash-generating businesses, give us an intrinsic value ranging from $84.24 based on free cash flow to $97.90 based on earnings per share. Both of these numbers are significantly out of alignment with the current trading price of $114.15. Visually, the gap is just glaring. While relative peer multiples might make Belden look reasonably priced in a hot market, the fundamental math of its own cash generation establishes a really firm ceiling. Both of our absolute models point to a true intrinsic value meaningfully lower than that $114 premium the market is asking you to pay today. So, given the robust historical cash flow data, but also the mathematical reality established by the source's fair value metrics, our judgment-based range suggests Belden is currently overvalued. Honestly, the current price has just run a bit ahead of the underlying cash fundamentals. And the source data itself delivers the ultimate warning shot. It explicitly calculates a negative 35.50% margin of safety based on free cash flows. Think about that. In value investing, a margin of safety is your cushion against errors in projection or unforeseen economic downturns. Right now, Belden offers absolutely no cushion. In fact, you're practically paying a premium for perfection. Let's wrap up with a final thought to see how this builds your investing strategy. With the forensic evidence clearly pointing toward overvaluation and absolutely zero margin of safety to protect your capital, the final question you've got to ask yourself is this. Are you willing to pay top dollar for a great business today, or do you have the discipline to wait for Mr. Market to offer you a much better price? Keep those models sharp and keep digging into the data.